And I think something in 2 days. So today is a session for review and our examination or final examination structure. Before I start that, I hope you all are aware that the due dates got extended. Did you see that for the research report? Still, if you have any question, you can ask me on that. So the due date for the research report is 7th of April, that's Tuesday. And PPT and recordings, the due date is Thursday. That is before the class, Thursday's class. Okay, so that we have more time. You can have good holidays. So any other question related to the report or the submissions of the due dates? I hope you all are doing good. Still, anytime if you have a question, drop me a mail. We can also have a Zoom meet if you want. I can help you on that. Not a problem. Okay. So what do you start with? With the examination structure or the review? Which one you want first? Structure? I think I remember some of you were asking, is that the full syllabus or the post-mid syllabus? Which one you want for the exam? Someone was asking, is that the full syllabus for the in the exam or for the post-mid or after the post-mid? So there you are, you'll be having the syllabus for post-mid onwards. Okay. So that is stock markets onwards till the last session. Risk management with derivatives. That is your scope for your interim examination. The format would be the same. It will be online. Okay. So 75% is for MCQs with different levels of questions, and 25 will be the descriptive. The same last time we had. The same on responders, lockdown browser, the timing, and so on. So I think one or two students got issues to use Excel while attempting the exam. That was sorted out with the COB tech support team. They said that the student can download the updated Microsoft, which is free for the students. That will solve the problem. Still, if some of you face any problem on that, there is a solution for that. Okay. So as usual, the finance calculator you can use, and scientific calculator will be available on the exam. The browser, it will be available for you all. You can do manually also. It's up to you. So all the choice. So I will make a video further on how to use the finance calculator, how to use the Excel for present value or future value problems. So unlike the previous midterm exam, this exam is not that problem rigorous. We had problems only in insurance, if you check that. Okay. So, but still, if you got some minute rigorous problems while doing your assessments and assignments, you may have that kind of a problems. Okay. But not that rigorous like we had in the midterm exam. I can assure you on that. Okay. So that is about the exam. Any question on the exam? Do you have any question? Julia? All clear? Jen? Gregory? Okay. And I think not last time, since the beginning, not just post-mid, some of you posted me because of your personal issues making you not to access a smart book or whatever. If you still have the problem, mail me on that. I'll resolve all those issues at once next week. Okay. When you mail me, you refer very clearly which chapter is a smart book or assessment or assignment or all three. Clearly mention one after the other so that I can work on that. So that may happen next week, Tuesday or Wednesday onwards. Okay. make a note of it. Don't feel you missed something. I don't want my students to lose the grades. That's my point. So you can work on that. That's not an issue. So assignments, exam, research report, all good. Any other question you have? Yeah.
So are we just going to be doing a review up until the 14th?
This week, this Thursday, we'll be doing the review, whole review. On Tuesday, we'll be sitting because Thursday is our presentation session. On Tuesday, we'll be having the session here, and I'm here to clarify any questions on the project or your readings through the preparation for the exam. So you're right. What you said is right in that way. But Thursday is specifically dedicated for our presentations, Q&As on your project. Okay. So any other question? There's no question. Let us proceed with the quick review on this. So let us look at the syllabus as a macro outlook on how it goes on. So this is all we had till mid-exam. Post-mid-exam, we had this stock markets, derivative markets, and currency markets in the markets. And in that regard, we also did group activity. You all did a good job submitting your group projects. Then followed by financial institutions specifically, we had commercial banks, other lending institutions, including small saving institutions or simply S&S or saving institutions, and credit unions. Then we also looked at specifically what are the regulations in commercial banks, and we looked at non-depository financial institutions or NBFIs, investment banks, investment companies, trading companies or securities firms. Then we moved on to the last part of our syllabus with the risk management, starting with the insurance firms or insurance companies. Then how do financial institutions they manage risk or how they're exposed to risk? We have seen on last week Thursday's class. In this week Tuesday's class, we have seen how derivatives were used, forwards, futures, swaps, options to manage risk associated with interest rates, forex rates, and asset prices. So now today we are here. So all are well described here. If you see any update, you can let me know. We can embed the same. Okay. So out of these topics, which one was comfortable and easy? Which one was a bit tough and demanded more efforts from you? Can any one of you respond to that? This is the scope for your interim exam. All are okay? All are equally? Yeah. Okay. One. That was easy or tough? Okay. Anyone else? Thanks for this. Yeah. Derivatives. The last one? Yeah. Risk management derivatives. Okay. Cool. Anyone else? Any other topic? Yeah. Cool. So we'll just focus on those two, but let us go in order one after the other so that we can quickly go through them. So quickly on stock markets, remember when you prepare for the exam, take care of the learning objectives. For every chapter, I put the first slide has learning objectives. So when you start learning, you question at the end of the presentation, the last slide has learning outcomes. You question, you cross check. It is a kind of checklist for you, right? You organize your preparation based on the learning outcomes. It will be easy for you all. Okay. So looking at stock markets, this is what we have seen. We started with the stock as a derivative, as a security, differentiating common stock and preferred stock. And we have also seen how the stock was issued through an IPO or FPO, seasoned issue, or old shares, or follow-on public offers, all are same. Okay. Then we looked at stock exchanges or secondary stock markets, how they are different from primary issues. Then we looked at how trades take place. We discussed about bid-ask spreads, the codes, and so on. Then we identified major stock markets and their indices, and we also have seen stock market participants. This is where we have seen designated market makers or DMMs or dealers. Nowadays, they are known as dealers. New York Stock Exchange um, um, operates on DMM model. NASDAQ also have that, but the New York Stock Exchange specifically have a dealer for one specific stock. But in the case of NASDAQ, many will be dealing with many stocks, or one will be dealing with many stocks. And we also touched forms of efficiency. Quickly, can you tell me what are the three forms of market efficiency? Efficient markets: weak form, semi-strong form, strong form. These are the three forms of market when you talk about stock markets. Weak form is historical prices doesn't reflect any new information, so you cannot make money or abnormal returns using historic prices. Chartist or technical analysis doesn't work. That's what we discussed. Then we also touched on international stock markets, the same things. Okay. So these are what we had. Maybe I will quickly go through one after the other. Internal equity and external equity. You got the difference between an internal equity and external equity? Internal equity and external equity. Did you get the difference? It's also an outside equity. Inside equity, outside equity. Inside equity refers to free cash flows that were seen on assets part of your balance sheet. Okay, that is internal equity. So how does that come to you? When company makes money, it retains the earnings for future projects. So that's how it becomes a reserve or retained earning, or it is also simply known as cash or free cash flows. External equity is stock is issued to individuals or institutions who are the owner, who become the owners, but it can also have in the form of common shares and preferential shares. So I'm just rolling. You can stop me or ask me. I just generalized everything. Specifically, if you look at something you need, you can stop me or ask me. So we looked at stock markets, forms of efficiency. So research says that weak form and semi-strong form exist, but strong form doesn't exist. It is very tough. Strong form is the form where even private information is also reflected in stock prices, where public is aware of it, which is quite rare. At least in US, we have something called Disclosure Act, where the insiders, the executives, employees, or whoever it is buying the stock or selling the stock, they have to report, they have to inform SEC within 2 days. So that it will be for the public. So it is illegal without disclosing and buying the shares or selling the shares when it is not public. Okay. So strong form is little tough on that. weak form and semi-strong form, they do exist. There are run tests, filter tests done on this. So stock market has huge regulations, a lot of regulatory bodies, SEC, Sarbanes-Oxley Act, simply SOX, and SROs, the exchanges themselves, then FINRA. I think some of you are busy with FINRA certifications also. Any finance job requires a FINRA module. Then we differentiated primary and secondary markets. New stock is issued. Secondary markets. The codes are important. When you buy stock, it's not just the commission or the fee or the brokerage you pay to the broker, but it is also the spreads. The market makers, they always have bid-ask spreads. So they also make money because of your trade. Okay. So that is also a cost of trading. So when you look at who is holding more shares of the companies, it is households of around 80%. They directly buy through by themselves trading accounts, and they also indirectly buy through mutual funds or pension funds. The ownership lies there, followed by institutional investors. So when you look at stock markets, there could be stocks which are listed, and sometimes based on the class of the shares, you may have a different trading pattern. You own some stocks, but you cannot trade them because either they are restricted or they're privately placed by the company just for you. And there are some private company shares which are not public. They cannot corporate, non-corporations, they still have the shares, but they cannot. Then when you look at the stock exchanges, you have national level stock exchanges. You also have regional stock exchange like Miami Stock Exchange. I think we also have seen the history of stock exchange. Philadelphia Stock Exchange was the first, if I'm not wrong. Let's cross check. In addition to that, you also have alternative trading systems. When electronic trading was not available in modern days as we have today, those days ATMs were quite active, where you can directly skip the market and trade for yourself. That is more known as ATM. Over-the-counter markets, it's completely a private deal between companies or individuals. Some stock exchanges, this is the list of regional stock exchanges in addition to National Stock Exchange. New York Stock Exchange is dealer-driven. NASDAQ is also dealer-driven. There is something called algorithmic trading, I think introduced in 2013, if I'm right, okay, where you can have automated or mechanical trading based on the price movement or index moving. So when you calculate equities, we have been calculating returns since your pre-mid exam time onwards. Bond yields, dividend yields are the basic calculations. We repeated the same. I'm not sure this you will get for the exam or not, but I gave this the time just to recall, to make sure that it is okay for you. ECNs, ATS. So top 10 stock exchanges we have after New York Stock Exchange index, Dow Jones and S&P 500 in the global scenario. So that is on stock markets. So derivatives market or derivative markets. So before we get into markets, it's important to know the difference between various derivative instruments. Okay. So I think I had been doing that. Again, I'll be doing now. So when we talk about derivatives, you basically have four important types. Okay. One is forward to start with. Forward is the first form of derivative, we can say that, followed by futures. Forward and future, they are the same. There's no difference as a contract. But the difference is what happens after getting into the contract. Forward is a very private contract between two parties, very customized in terms of the quantity, the date, predetermined date, and agreed price. Agreed price, it happens anywhere. It is mutual understanding, mutual consent. Whereas in the future market, it is standardized. It is fixed. For example, if you want to buy S&P 500 index futures, it is a minimum of 50 and multiples of 50. If you want to buy sterling pound currency futures, okay, it is minimum of 100, multiples of 100. It goes like that in commodities derivatives. Okay, I'm sorry, currency derivatives. Same is the case with if you want to buy gold, it is minimum 1 gram and multiples of that. It goes that way. But when it comes to forward, it is highly customized. It could be 100 kgs or a ton or a quintal kind of thing. It is mutually agreed. That's the difference between forward and future. Okay. Option is something different. Futures, options, both are market driven, standardized, standard products. They are designed by the market to all. Okay. But the difference between a future and forward is that future and option is that option has limited risk. I think in the previous class, I was mentioning you that if you understand this, I think the whole picture is straight to you. This is a future. Okay. So if you take a position, for example, here, you have unlimited, those who have little difficulty in futures or derivatives, look at the board. You have unlimited profits if you have a long position, and you have a limited loss, but for example, Tesla is 350. The maximum loss, if you buy a future, the downward risk is it may become zero, not beyond that, right? So maximum loss is 100%. Maximum profit is unlimited. 350 may become $700, 100%. It may become more than that, $1,000, $2,000. So you never know. It is unlimited. That way, upward profit is unlimited, downward loss is limited but 100%. Okay. Limited does not mean that you are safe. It is huge risk. Losing whole of your money is huge risk. Okay. Now when you compare this to option, okay, you buy a 350 strike price Tesla, say for $1 or $2. Okay, what happens? This is your risk. The $2. Upward profitability is unlimited. You buy Tesla for 350, you have the potential to make money in an unlimited fashion. But downward risk, you just lose $2. That is the basic difference between option and a future. So, but the problem is options, if you are hedging, it is easy for you to take an option. Okay. But if you're trading, more people, more traders, more investors, they look at futures because there is more volatile. It is more volatile. There is more volatility. You can buy and come out of it within few minutes or few hours. But options, they may not be that volatile. Okay. So remember, when you talk about derivatives, you have traders, speculators, arbitrages, and hedgers. But the whole scope or the goal of a derivative is hedging. After that, it could be trading or speculation or whatever. Okay. So so every forward or future or option or swap or any other derivative has an underlying asset. Okay. Underlying asset could be equity or bond or interest rate or commodity, anything. Remember, we are talking about financial derivatives. We may also have non-financial derivatives like sports derivatives or weather derivatives and so on. That's not part of our discussions. We are talking about hedging, which is a financial hedging. Underlying asset is a financial asset. Okay. So forward markets, futures markets. It could be futures could be on fixed income securities also, not just equity. It could be on short term as well as a long term fixed income securities or debt instruments or government securities. Remember, when you talk about fixed income securities, government securities are much bigger than corporate securities. Corporate securities market is very small, but government securities, government T bonds, T notes, they're huge. They happen every week. They get issued every week. Some examples. Option market. So we have call option, put option based on the contract type. And we also have categorization based on the underlying asset, stock option, index, commodity, currency, interest rate, or futures options. So option on futures means underlying asset is a future. Call option and put option. I think I gave, yeah, this is the payoff. This is what I was trying to do on the board. This is the long position of an option. Okay. Short position on a call option. This is a long position on a call option. If you are looking that, if you are expecting that the prices will fall, then you take this to hedge. If you have, for example, let us say you have a Tesla in your portfolio, right? 100 or 1,000 shares, and you are so disturbed that the stock price may fall in the coming month, but you don't want to sell because Elon Musk is announcing dividends or issuing some bonus stock or whatever. So once you get that, you want to come out of it. Then strategy is you hold the equity of Tesla and you have a downside risk. So then you have two options. One is take a short position in call option or buy a put option. Make sense? If you have a downside risk, if you don't want to lose the stock value, then you take a long position in put option or a short position in call option. Both will hedge your risk. Why? Because in both the cases, you make money in this derivative when the price is coming down. You may lose in your stock, Tesla, you're holding, but you will gain here. It is offset. Say, for example, I don't want option because I have to pay some premium. There could be huge difference. I want to take a position in futures, for example. Then take a short position in future. If you take a short position in future, price goes up, you make money in your underlying stock. If the price is falling down, you make money here because you have a short position in Tesla future. And with option, you buy a put option. And the price falls, you make money here. Okay. So the other way, the upward risk. When do you have a upward risk? The price goes up, you're worried. When does that happen? Can you tell me? Anyone? Price is going up, but you're not feeling good. You're feeling bad. Yeah.
You're asking what that situation.
Sorry?
You're asking what we should do in that situation and what that
I'm just comparing this example with the previous example. You hold Tesla, price is coming down, you're worried. You feel bad and you feel that is a risky option. Then you go for a short position in future or you buy a put option because you hold the stock. Downside risk. Now, in contrast, my question to you is, I'm asking about upward risk. Tesla price is going up. I'm worried. Why I am worried? Exactly. You have a short position. I sold the stock and I make the money if the stock price is coming down. My position is short. Okay? So if I feel that, then I can go for a call option. I will buy a call option. Okay. I will take a long position in future. Both will hedge my risk. I'm perfectly offset. Of course, that's what this is how risk is. We are discussing the project. We are talking about the hedging, which we discussed in the previous session. This is how you use derivatives for hedging using stock derivatives, stock futures, or stock options. Okay. So when you talk about swaps are more with foreign currency and interest rates. Yeah. Swap is all about an agreement of exchanging the underlying asset if something happens. Okay. Exchanging what? Exchanging, I have a loan in US dollar and my friend has a euro dollar loan. Because of the exchange rate differences or internal economy differences, if something happens in future in any one of the respective economies, in terms of GDP or currency rate or interest rate and so on, the whole things get disturbed. Okay. So in that case, let us swap our positions. That is one way of looking at swap. The other way is swap of interest rates. I have a loan with fixed interest. My friend has a loan with floating interest. Okay. So when interest rate is, why I had taken a fixed interest rate? Because I feel in future it will go up. Why my friend has taken floating interest rate? He or she is feeling it will come down in future. Okay. But we never know. What happens if the interest rate fall? I'm not happy. What happens if the interest rates go up? My friend is not happy. So what we agree is, if at all interest rates go beyond some level or goes down some point, then let us have a exchange. So exchange could be only for interest rates or for the whole value. Okay. So that's how the swap works. Then we also have credit default swaps. I had been telling you about that. It is just a absolute insurance kind of product where company will be reimbursing in case someone defaults. Like I think Lehman Brothers example, it defaulted billions of commercial papers issued, and the insurance company was AIG, which has issued credit default swaps. Because Lehman Brothers defaulted, it has swapped, means it has paid to all its investors. That was huge. It was almost like a threat for its survival, but federal government came to the rescue, and it was safe. AIG, I'm talking about AIG. So I think those were the important and interesting discussions on derivatives. Starting with forwards, futures, options, swaps, and so on. Daniel, is that okay? Clear? As a product, as hedging, it has two dimensions in your post-med exam. Okay. Okay. And let's move on to foreign currency. You take any market, fixed income market or stock market, you have specific market timings. But Forex market is the market which is available and open 24/7. Not just now because we have the technology nowadays. In the olden days, decades back also, it was working round the clock. Okay. If Japan market is closed, China is open. China is closed, UK is open. UK is closed, American is open. So round the clock, it is available. Trades happen across the world. So in foreign currency, we had foreign currency discussions related to markets to start with. The trading patterns and others are the same. Only thing is it is more on basis points, unlike the stocks. The difference is exists there when you compare a stock market and forex market. So there are more of OTC markets, unlike stock exchanges like New York Stock Exchange or NASDAQ or any international market. Foreign currency trading happens on OTC markets. And top 5, these are the top 5 currencies which are traded. US is always on the top. I think this is by 2025, if I'm not wrong. Close to 90% of the foreign currencies trade with US dollar, okay, followed by euro dollar, then Japanese yen, then sterling pound, then Chinese yuan. Why these 5 are top 5 foreign currency traded? What could be the reason? When you try? Why these 5 currencies are top 5 currencies? What made them top 5? Why not Singapore dollar or Australian dollar or Indian rupee or Chinese yuan is there right now? Or Brazilian currency? Why not those currencies? Why these 5? What's the reason? Maybe if you look at top 5, you will have more. Yeah. It is the strength of their economies. Okay. Okay. You hit the right point. I think till 70s, Chinese yuan was one of the biggest. And developed countries, they always had sanctions because they didn't have open economy, but their economy is so strong. Similarly, to some extent, for some period, it is Russia. It was so strong, but ruble was not traded part of a top 10 or top 5. Okay, strength of the economy is one point, but beyond that, it is more about the foreign trade. These are the countries, if you look at their stake in global trade or world trade, you will see these have more trade than other countries. There is a high correlation between the size of the country's trade with other countries and their currency get trading. Got the link? That's how foreign currency gets traded. I think euro dollar was nowhere till it was launched. It is because of all the European Union countries, they formed together and they agreed to have a common currency, and their trade got strengthened, their economy got strengthened, and there was an increasing demand seen in euro dollar. So not just actively traded in the foreign currency markets, there are some countries which adopt one country's currency as their currency. Okay, like Panama, Ecuador, El Salvador, they have US dollar as their own currency. That you called as dollarization. So I just talked about euro dollar. Sterling pound is still out of euro dollar. It has its own trade in its own currency. Yuan was there in the old scenario in terms of trade, but it was moreover pegged with US dollar. So there was no active trading for there's no volatility to talk about hedging with yuan in foreign trading if someone is trading with yuan. Okay. I think if you remember, we had this discussion, a direct quote and indirect quote or inverse quote. US dollar versus sterling pound. How many pounds for $1 is a direct quote? The other way, how many dollars for one sterling pound, foreign currency? That is an indirect quote. There is also a cross quote. You have the quote between US dollar and sterling pound, and you have a quote between sterling pound and say Singapore dollar. If the direct quote between US dollar and Singapore dollar is not available, you can have a cross quote. You can convert that. That you call it as cross quote. Some exchange rates, trends. And as we discussed about derivatives, foreign currencies are more with forwards than futures because they trade on OTC markets. The underlying asset, foreign currency itself is on OTC market. So forward market happens in a very customized manner. Assume US dollar and Chinese yuan, they peg their exchange rates. Like I told you, till 2006, 2005, it was pegged. In this scenario, do we have foreign currency risk for these two countries? Did you get the question? Currency of US dollar and yuan. What's the exchange rate? Can any one of you quickly tell me? Yuan and US dollar. How much is the exchange rate, Brendan? Anyone? Yuan how many yuans for $1? No?
$1 is 6.71.
Yuan. Okay. So do you feel that was the same last month? Can you check 1 month back price? Yuan versus USD. It is 6.87 yuan for $1 today. How much it was 1 month back or 1 year back? Any other number?
Like 6.89 to 6.91.
6.89 was 1 month back, and now it is 6.87.
87, so it's come down to 6.
Okay, it was a little down, but almost the same. So what I'm trying to ask you is, assume there is no change in exchange rate of US dollar and Chinese yuan. Okay, it is the same 6.8 for all the months, all the days, all the weeks. 6.8. My question to you is, if it is the same, do you have foreign currency risk? Yes or no? What do you think? Exchange rate is the same. Today, yesterday, last week, last month, last quarter, last year. It is the same exchange rate, 6.87 between US dollar and Chinese yuan. In this case, you see a foreign currency risk or there is no foreign currency risk? There is no foreign currency risk. It is the same exchange rate. Exchange is pegged. Exchange rate is fixed. So there is no foreign currency risk at all. We need not talk about forwards or futures on this. If at all there is a exchange rate risk, we have derivatives. Okay. So that's how the risk arises with the foreign exchange risk. So what kind of companies have a foreign currency risk? Companies which are exporting, companies which are importing, banks which have given foreign loans, banks which have foreign deposits for short term or long term. They have foreign currency risk. I think OBS off balance sheet is very important. Derivatives are more of off balance sheet activities. So some trends are there. So it's not that you are buying something in foreign currency and you have the whole risk. No. You're also selling. So compare these two, and that net position is your risk. A company has a sales of $1 billion to European countries in euro dollars, and at the same time it also has $1 billion of purchases in euro dollars. Then there is no risk, almost offset. So net exposure is important for a financial institution or a company. So when you look at forward rates, you should look at volatility of the interest rates and the inflation in future for the coming month or year. So purchasing power parity says interest rates exchange rates should be based on the inflation or purchasing power of the respective economies. Higher the inflation in the other country, then your country's currency should be stronger. Higher the interest rates in other country, then strong should be the other country's currency, because more return if someone is investing there. So that is purchasing power parity theory. Interest rate parity theory is based on the interest rates. So in today's world, we should consider many things: interest rates, inflation, and importantly, the trade size, the volume of the trade. Okay. So that was about foreign currency markets. Julia, any question on this? Clear? Okay. Then commercial banks, we came to financial institutions. Commercial bank is the biggest form of financial institution in any country. And I think I had been telling you, there are some countries which are markets driven and some countries which are institutions driven. US, UK, and so on. We are markets driven. Markets serve as the bridge between the suppliers and demanding sections of the economy. People who demand money, people who have surplus money, they get to the market and they fulfill their needs. Okay. But in the case of institutions driven, there are no markets like Germany, France. There are more financial institutions driven, but they're also driven by the markets. But the trend has changed. If you look at, there was a Raghuram Rajan research on financial markets and institutions. He proved that he separated the whole thing into common law and civil law countries. Common law means the regulation is more on courts based, justified judgments and so on. But civil laws are more about a strict rule passed on to everyone. Okay. So what they said is when LLSV proved that common law countries had better investor protection, but he said that no. If you look at 1913 onwards, these civil law countries are much bigger and stronger than UK or US. But later on, the trend got reversed. Why? Because of a kind of conservative culture which developed because of the new entries due to the globalization. That was an interesting study. So even now, still you can find financial institutions driven and financial market driven economies, right? So when you look at commercial banks, we have a variety of product and so on. I think if you had a marketing kind of course taken, you'll have more kind of variety of product line of the banks discussed there. Here now we are worried about the financial dimension of this. So we'll be looking at more assets and liabilities and other important issues. So they are the how do commercial banks make money, make profits? How does a bank or commercial banks, what is their business model? Okay, before lending, how do they get money? That's it. Simple. I'm the mediator. I take money from you and give a loan to you. I take money from you for 3.5%, give loan to you at 6%. The difference is the profit for me. Very simple. Okay. And in addition to that, they may also have equity shown on the balance sheet, but this is the business model of a bank. That's how they make money. So when you look at banks' assets, it is more of loans, right? And if you look at liabilities, it is more of deposits. And I was comparing this for a company. If you have deposits again, if you take a company like Tesla, go to Yahoo Finance and check for its balance sheet, you will find deposits as a asset for Tesla and loans as a liability for Tesla. But here we have the other way. You see this here? They're different. It is asset here, but it is a liability here. So this is because their business models are different. This is how the banks work. Okay. So some interesting numbers. More. Actually, this was interesting. If you look at this is the asset, right? We have more of securities and loans, 22%, almost 10%. So put these two put together, loans are 30%. Individual loans 8%, 38%. What's this? I can't see this. 38% plus 8, 46. So 50% of the bank's assets are loans. You can see here. Okay. Apart from that, they also have securities and other reserves. Then I think we can also look at the liabilities. So this is where I was telling you, securities are more from 2020 onwards, 2019-20 onwards. That was quite interesting, more than assets. Then, yeah, liabilities. Transaction accounts alone had 23.3%. Then non-transaction accounts 48.1%. The term deposits, time deposits. Okay. I think this is quite easy to understand financial institutions because we have been repeating the same for commercial banks and other things. So any one of you had any one of these banks in your MyFI, in your report? One? Anyone? Okay. I hope just cross-check in case when you selected an FI, just go through all the companies in discussion so that no one else has taken your company. So we discussed about shadow banking, where it is a company doing a banking activity, but doesn't come under Federal Reserve regulations. Okay. Finance companies, we can call them as. We'll be talking on that. Again, we'll be repeating them again. So federate is everything for the banks. Whenever there is a federate cut or increase or no change, the banks do respond based on their expectations. Importantly, mortgage rates. Whenever the mortgage rate cuts are there, you see commercial banks stock prices going up because it's good for banking industry. So these are the important regulators. FRS, OCC. FDIC is very important because your deposits with the banks are insured. You also have the regulation at the state level. My numbers are a little outdated. It could be around $30 trillion as of now. So like I showed for top 10 banks in the US. And by the way, you can also pick any international financial institution of your choice. I missed that in my last session. You can do that if you want, not just American banks or American financial institutions. Okay, that's it about commercial banking. Then apart from commercial banks that we have seen, we also have banking institutions which are not like commercial banks. Why they are not like commercial banks? Because their size is very small. So we have small financial institutions. We have small financial institutions, savings institutions, credit unions, financial companies. I was talking about shadow banks. Quickly on them. So these are known as the thrift saving institutions because their objective is that. Within savings institutions, you have S&Ls and you also have savings banks. The difference is the ownership pattern. Apart from that, the goal is the same almost. And S&Ls, savings and lending institutions, home loans are 100%, whereas savings banks, they can give loans to they can give mortgage loans or else consumer loans or any other loan, but not business loans. You can see here, there is a clear restriction on not more than 20% commercial loans. It should be only for personal loans or mortgages. S&L crisis because of the default rate. Then the Savings Association Insurance Fund was set up. You can see the failure rates here because of lack of insurance and protection. I think commercial banks assets are reflect the same for small institutions or savings institutions. Some numbers. Credit unions apart from the savings institutions. Okay. You have different tiers on credit unions with the US Central Credit Union as a top tier, corporate credit unions and local level credit unions. They are focused on local borrowers and lenders. I think it's the same for almost the same. Remember, this small institution cannot have more than 20% commercial loans. That differentiates the assets and liabilities. So I think 2008 was a very bad period for 2008-9 was a bad period for all financial institutions, including credit unions and small saving institutions. FCs are like any commercial bank. But they do that because they have the product line where consumers are going for loans instead of going inducing the consumers to take a consumer loan from a commercial bank. The company itself makes money out of it. So you can see here, consumer loans are more for these finance companies. 52%, that's very high. So the regulation is different. That's where all the banks protest or they are against FCs because of lack of equal regulation. So that is about Other financial institutions, banking. Is it okay? Any question on banking? You can ask me. I think regulations, we'll skip that. We had a bit introduced here. You can specifically go with that. Then apart from banking, we also have non-depository financial institutions or NBFIs, non-banking financial institutions. We have investment banks, security firms, investment firms, venture capital firms, and respective regulations. So when you look at investment banks, you have national full service firms into banking, corporate financial services, and they also act as large investment banks. So specifically about investment banks, commercial banking and corporate financing and large investment banking activities. I gave some of the examples here. So when you look at corporate finance activities here, they are more active as underwriters in primary markets. They do a lot of road shows to make the public issue successful. In M&As, mergers and acquisitions, they do a lot of target search, valuation, and close the deal. This is the whole list of, I think those who have chosen an IB, this will be directly related to you, taking care of their own services. It does not mean that all the investment banks will offer all these services. Some are specialized in that. Some have very high income on one specific thing, others have low. Those differences are always there. So the market leaders, top 10 we have here in terms of their assets. So they do underwriting. Underwriting is guaranteeing the success of the public issue. They do M&As, target search, pricing, and so on. Then we have security firms where they do operate as dealers, market makers, and so on. And we also have investment firms, private equity firms, and venture capital firms. Private equity firms invest in already listed companies, okay? Whereas venture capital firms, they look at startups, okay? Very small companies which has huge potential, they identify that and they pump money, okay? That is investment firms. You can go through them if you want more on that. Then insurance companies. Broadly, we have life insurance companies and P&C insurance companies are property and casualty insurance companies. I think this is where I was talking about the problem. The fair value calculation could be a problem for you in the exam. Go through that, practice some problems from the book or assignments or assessments you have. End of the chapter, importantly, from the book you will have. Okay. So the difference between life insurance and P&C is life insurance is all about personal insurance. When a person loses the life in an accident or due to illness or a health cover and so on. But whereas P&C is all about business and material things, you can insure anything. The popular things are automobile, liability insurance, homeowners insurance, commercial insurance, fire insurance, and allied lines. So when you talk about insurance, underwriting and actuary science is highly demanded. That they are the people who dictate terms on whether the coverage risk protection should be accepted or it should be rejected. We talked about adverse selection risk, where risky people may take more insurances than healthy people. Okay. Then I think, yeah, that's it. In the last class, no, financial institutions risk quickly. I will just give you the whole list of risk sources. When you talk about risk of a financial institutions, this is a maximum scope. But commercial banks, when you look at commercial banks, you should look at their liabilities. You should look at both assets and liabilities, which differ. And when you look at the sources or types of risk, I think these four are very important: credit risk, liquidity risk, market risk, interest rate risk. Right? We also discussed about systematic risk and unsystematic risk. Systematic risk is uncontrollable. You cannot manage it. Okay, I think that's it. Still, if you have a question, you can always email me. We can have a discussion on that. Thank you. Have a great weekend and holidays. Yeah, that's not present. Hey, good. Give me a minute.